Good morning and welcome to Stock Market Today. It's Thursday, January 10th, 2019, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at Dan Russo _ CMT, and if you're on StockTwits, I'm there as well under the same handle. That's at Dan Russo _ CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. And if you head over to chaikinanalytics.com /today, you can sign up for a free email, follow along with this show, and get stock ideas in your inbox every day. U.S. equities were higher in Wednesday's trading, with the S&P 500 gaining for the fourth straight session. NASDAQ and Russell 2000 leading. Energy and tech were the sector outperformers, while the defensives and comm services trailed. Treasuries were mixed, with the curve steepening. Dollar was weaker on the major crosses. Gold up 50 basis points. WTI crude settled up over 5%. Some commentary out of Saudi Arabia about potentially increasing the amount of production cuts. So as we dive in a little bit and get to the desk today, however, S&P futures are down 50 basis points following 4 straight days of gains. Asian markets were mostly weaker overnight. Japan lagged, down more than 1%. European markets are largely on the defensive this morning as well. Treasuries are catching a bid across the curve. Dollar is mixed following further weakness on Wednesday. Gold up 10 basis points, and WTI giving some back a little bit. It's off about 80 basis points after finishing higher yesterday for the 8th consecutive session. So what do we have here for the S&P 500? We have a 4-day rally into the resistance range now. We've been highlighting resistance in the 2600 to 2630 area as a point to kind of wake up. Actually got very close to that level yesterday, the underside of that level at 2600 before fading. As for support, I didn't put the levels on the chart. I don't want to crowd the chart. Basically what I'm doing, though, is I'm using Fibonacci to find retracement levels, potential retracement levels off this move. First key retracement level comes in at 2530, then below that at about 2500. And what we're looking for on retracements to support, or in particular, a move back to the December lows, is a less intense test. We want to see momentum divergences. Haven't seen that yet. We want to see breadth divergences. Haven't seen that yet. We'll go through that today. It's a big topic in my note to Chaikin Analytics members. And we also want to see sentiment divergence. We haven't seen that yet. And I asked the question here, where is momentum? We have had this monster rally off of the Christmas Eve lows, deeply oversold conditions, but the RSI doesn't even get above 60. Where is the momentum to this move? That should be a warning sign to the bulls here if you're thinking about chasing this rally today. And on top of that, Chaikin money flow is still bearish. Diving in now, our market in a minute, what I'm talking about in my note, Chaikin Analytics members today, S&P 500 testing resistance near 2600. Fine, we hit that. Small caps remain bearish despite leading since the lows. Small caps have had great performance since the December lows. A little bit of the January effect coming into play here, where small caps tend to outperform to start the year. What's interesting to me is the Chaikin Power Gauge ETF rating is still bearish on the IWM. We will take a look. Industrial underperformance likely to continue. We'll take a look at that one. Breadth metrics improve. All of the breadth metrics that we track have improved. The long-term trend metric, for the 200-day moving average, we'll look at that one. But what's interesting to me is that the short-term measures signal overbought. If we look at the percentage of stocks above their 20-day moving average, it's back above 70. 2 weeks ago, this measure was at around 2%. And we said at that time that marks the type of environment which can lead to a tradable low. We've had a nice rally. Now we're overbought, and futures do point to a lower open. Let's dive in now to the Chaikin power bars for the major indexes. Still seeing some improvement, but also still everything very much skewed to the bearish side. Dow, one bullish stock. It's been 0 for a while, but still 7 bearish or very bearish stocks. S&P, 32 for the bulls, 139 for the bears. NASDAQ outperformed yesterday, 11 bulls, 28 bears. That's seeing some improvement. And small caps, remember back in the summer, it was the small caps that really started to deteriorate first. Now they're starting to improve. Now, listen, they are still 2-1 in favor of the bears, 223 bullish stocks, 455 bearish stocks. But it's a starting point. if we're going to start to build a durable base for the S&P 500, we would expect to see the small caps kind of leading the charge. We are seeing it there, so let's see how that plays out. The first sign is there, but we don't have the all clear yet. Bonds down tick, energy, great day with oil again up eight days in a row, but still a very bearish skew to the power bar ratio for energy. One bullish stock, 18 bearish stocks according to the Chaikin Power Bar. Small cap stocks and large cap stocks are bearish. Stock of the day now. This is a stock for you to consider. I urge you to do the research, follow the process. Don't just take the stock of the day and run out and buy it because, quite frankly, I don't think the setup is there for this one today. Interesting name. We're going to add it to a bullish watch list. It's LPL Financial, LPLA, up 2.27% yesterday to close at 64.87. Has a very bullish Chaikin Power Gauge rating, and that's due to very strong earnings performance, attractive financial metrics, positive expert activity. Stock, though, is in a downtrend, if you will, so the technicals are weak. Very bullish stock, strong trend as we've gotten above the 200 of the long-term trend line here, but longer term, the trend is down. Weak industry group. What's interesting to me here is that we've just turned to this very bullish rating. Stock began to outperform in December. Now the market and model are in agreement. Dynamic Duo is in gear. Type of name that we want to consider. However, not right now. Stock is very overbought. Money flow, while improving, this is encouraging. Deep bearish money flow. And then as we're kind of testing the lows here, money flow turns bullish, and now it's kind of neutral. This is encouraging to me. At the very least, the institutions have become less aggressive in their selling. What I want to do now is watch for stabilization in this stock. I want an oversold reading, and then I want to revisit it, which is why I'm adding it to my bullish watch list here this morning, but not pulling the trigger. Taking a look at our sector tracker, movement of the last 5 days. Not much of a change to the picture here. A lot of the short-term trends remain in place. Energy outperformance driven by that strong rally in oil. Comms are both offensive and defensive after the reconstitution. Group is act well. Consumer discretionary catching some bids. I think that rally's counter-trend in nature. Market did not like what Kohl's had to say this morning, CSS. That stock is trading down over 6%. Real estate, defensive properties catching a little bit of a bid here, but the utilities and the staples are at the bottom of the list. I think these trends are counter-trend in nature. Again, I've said it before. Position squaring as the new year comes into play. I don't think we're out of the woods yet. I still think you want to be positioned defensively, and I think you want to be putting yourself in an opportunity for as the market does build a base and we do start to see those divergences, then you can get aggressive. I'm not chasing the rally here. Our industry in focus today, regional bank services. 2 very bullish or bullish stocks, 12 bearish or very bearish stocks over the past 6 months. This subsector has underperformed by over 11.5%. And that power bar ratio, which measures future potential, is very weak. With more bearish than bullish stocks, it's currently ranked number 15 of 21 subsectors. And it's actually moved down 6 slots over the past week. Remember, these regional banks are very much going to be tied to interest rates, and in particular, the yield curve. As the yield curve has continued to flatten, the banks and the regional banks have come under pressure. Your indicative stocks within this group, all with very bearish Chaikin Power Gauge ratings: Heritage Financial, HFWA, First Republic Bank, FRC, and Bach Financial, BOKF, all have very bearish Chaikin Power Gauge ratings. Let's take a look at one today. It's Bach Financial. Very bearish stock. Weak trend, weak industry, fishing in the right pond. Very bearish rating since September, October, underperforming the market since the summer. Market and model in agreement, dynamic duo in gear. You do not want to own BOKF. And in fact, if you do trade to the bearish side, you might want to consider opening a position here. Why? Dynamic duo in gear to the bearish side, overbought stock, very bearish Chaikin money flow. Nice rally here to the upper half of the volatility bands, starting to run into near-term resistance in the $80, $85 level. I think that if you trade options, you want to consider put options or bearish vertical put spreads in BOKF if the liquidity is there. At the very least, Definitely do not want to be long this stock. Trending names now, looking at S&P 500 gainers and decliners. Lennar up 7%. Commentary on traffic trends rising in line with declining rates. ISRG, fourth quarter pre ahead of JP Morgan conference, sends that stock up 7%. DR Horton, DHI, caught an upgrade. Interesting to me, home builders are starting to perk up a little bit. This is a group we've been bearish on. Starting to see a potential change of trend there in the home builders. I definitely think it's something to keep an eye on. Right now, Lennar, DHI, and Pulte all kind of look interesting to me, but in the near term, they are all overbought. Add them to a watch list, though. I think they look interesting. Abiomed seeing some follow through. No real reason that I can tell for Lam Research being up 5%, maybe a little bit of a rebound after the negative pre-announcements out of Apple and Samsung. Constellation Brands lowers guidance, sends that stock down 12%. Digital Realty down 5% on their guidance. Estee Lauder caught a downgrade, sends that stock down over 3.5%. CVS, investors did not like what they heard, I guess, at the JP Morgan conference. That stock down over 3.5%. No real news in CenturyLink to send that one lower by over 3%. So diving right in, what are we talking about here? Despite the rally, small caps remain bearish, and this is what I mean. I'm going to look at a Chaikin chart here. We have ratings on over 400 ETFs. One of them is IWM, has a bearish ETF power gauge rating. You can walk through the process in the same way. Bearish rating, underperforming. Now, the intensity of that underperformance has decreased. Small caps have actually been rising faster than large caps to start the new year, but it's still, from a trend perspective, an underperformer. Fund is currently overbought, bearish money flow, trading into resistance. I think if you own some small caps or have a lot of small cap exposure, now is a good opportunity to manage risk, maybe raise some cash levels so that when we do get those less intense tests of support, you have some dry powder to put to work. I think you want to manage risk in small caps. Industrials continue to underperform. Here's the XLI relative to the SPY. Clear downtrend below the 200-day moving average, confirmed by momentum as the RSI is in bearish ranges. Now, when we look on an absolute basis, seeing a bit of a rally here, maybe some optimism about trade talks. Looks counter-trend in nature to me, though. Steady downtrend, lower highs, lower lows. Textbook definition of a downtrend, as well as this underperformance, kind of doesn't really get interesting to me until we can get back above the 200-day moving average on a relative basis and see some confirmation to momentum. I think maybe you want to consider opening positions or taking some money off the table in industrials. Look at a name like Honeywell. It's my stock of the day today for Chaikin Analytics clients. Bearish stock, weak trend, weak industry group. Dynamic duo in gear as the market and model are in agreement. Stock's been underperforming since late October, early November. And since the beginning of October, money flow has been extremely bearish and continues to be so. Overbought triggers a sell signal today. I like selling Honeywell. I like opening a bearish position. A lot of resistance overhead beginning at around $140. I think the risk reward to the downside is favorable for bearish investors in Honeywell. Now, breadth metrics improve with price. Here's a percentage of stocks above their 200-day moving average. Nice rally, really just tracking price. Now, what we want to see is divergences. We want to see, when the market tests these support levels, we want to see higher lows in this metric. And ideally, from a trend perspective, we want the percentage of stocks above their 200-day moving average to be greater than 60 to signal that a healthy majority of stocks are in a long-term uptrend. That is not the case now. And as I said, in the near term, if we looked at this same chart for the percentage of stocks above their 20-day moving average, it's really spiked with the market here. It's back above 70%. Near-term results for the index tend to be very choppy in that environment. So I think we've had this nice rally here when that metric got deeply oversold. Now it's deeply overbought. I think you want to look for opportunities to manage risk. That wraps it up for today, folks. Get daily stock ideas for free, ChaikinAnalytics.com/today. And just as importantly, you'll be able to follow along with this show. I will see you here tomorrow, same time, Same place. Have a great day.